Right, I think that's a good enough number. Let's start. So, hello everyone, and welcome to another session in our Markets Masterclass series. I'm Sapna Patel, part of the large corporate FX sales team at Lloyds, and joining me today is Luke Roberts, who sits on our commodity sales desk. So today we're going to use the next 30 minutes or so to cover the fundamentals of carbon trading. So to keep the call nice and clear, we have disabled all cameras and microphones. So if you do have any questions during the call, then please feel free to put these in the Q&A chat function and we'll be able to answer them at the end. So additionally, if you have any other team members who can't join you today, a recording of the call will be available on our website tomorrow, and we will share the link with you once this is live. So without further ado, let's kick off. Luke, do you want to take a few seconds to briefly introduce yourself before we get into the questions?
Yeah, that's great. Thanks, Sapna. First, it's great to be invited back. I know we did a Markets Masterclass a few months ago. So to be invited back, proves that it didn't go too badly the first time round. So I've been in the bank for 10 years, currently head of commodity sales. I know that it potentially looks like I'm sat in an aircraft control center at the moment, but I promise you, I am head of commodity sales. We've got a fantastic sales team here at Lloyds, helping our corporate clients to hedge their commodity exposures in these volatile markets across energy, metal, and agricultural products. So last time we looked at the basic commodity offering here at Lloyds, and today I'm going to be doing more of a deep dive into carbon emission hedging.
Great. Okay, so let's kick off. Carbon emissions trading. Let's start from the basics. So what is it and how is it traded?
Yeah, I mean, the basics is a great place to start, and especially for something as complex as, as carbon. So the first thing that comes to mind, I suppose, is the two different markets, when we talk about carbon. So you've got a much larger compliance market. So we're talking about 250 billion annual trading turnover, $250 billion annual trading turnover, and then a much smaller kind of voluntary market, which currently has a 2 billion annual trading turnover. The compliance market covers the kind of ETS schemes that we'll touch on in this session, and the voluntary market is more about carbon offsets, covering avoidance or removal credits. And so, yes, we're going to be concentrating on the compliance side today. Potentially, a future session in the future could look at the voluntary side, which would be great. And here at Lloyds, we focus on the EU and the UK ETS on the compliance side. There are many other emissions trading schemes globally. Thinking about the US, we've got California, Washington. We've got the East Coast states that are captured by the Regional Greenhouse Gas Initiative. We've got schemes in China, New Zealand, and more expected to be set up all over the world, emerging markets, such as Turkey, to help cross-border trade to reflect the cost of emitting greenhouse gases through the production cycle. And so, what are the ETS when we talk about them? So these are regulatory-driven markets where large kind of industrial emitters that are captured by regulatory schemes, such as power generators or airlines, are required to surrender emissions for their carbon emissions over and above a baseline. And so each year the cap reduces. In the EU, there's currently a 4% reduction on the total cap each year out to 2030. And these schemes do help to reduce emissions. So in the EU, emissions have been reduced by 35% since 2005. Because the cost of emitting incentivizes efficiencies across the system, which is kind of great to see.
Great. Okay, I think that's a really good kind of basic overview of what it is and how it is traded. So I also understand that there are some nuances around who and how carbon emissions are traded. Can you go into a bit of detail around those?
Yeah, so because these are regulatory-driven markets, it's quite binary. So clients are captured or not captured based on whether they have this, combustion installation and they take part in a regulated activity, such as aviation, metal refining, or power generation. However, trading accounts can also be set up by institutions. So, those that may be looking to facilitate corporate hedging, or perhaps even on a non-commercial, more speculative basis, people can set up trading accounts. On the UK side, for example, we see around 500 installations in scope. But this can be quite fluid as new sectors, can be brought into the system, such as maritime transport and waste incineration, that are due to be included over the next few years. On the EU side, the scheme covers around 5,000 installations. So you can clearly see that 500 in the UK, 5,000 in the EU is clearly only a small proportion of the kind of corporate population, and it is those who are taking part in those regulated activities that are captured under the scheme.
Okay, great. So I guess, and with those participants, as with most exchanges and markets, there are lots of rules to follow. So for those participants, what regulations do they have to be aware of in order to trade carbon emissions?
Yeah, so as a regulatory market, as you can imagine, there's lots of these to be aware of, and I suppose you've got both the physical side and then the trading side as well. So just layers upon layers of regulation. So obviously, clients have to track and submit, their own verified emissions. They then have to surrender the required number of allowances, from the previous compliance year. And these regulations do have a bite to them because, a late surrender or an incomplete application does carry a fine of, say 107 euros, per metric ton, and then you still have to purchase the allowances on top of that as well. So it does really have have some bite to it. For physical spot or forward transactions, when we talk about regulation, these are eligible for VAT on a reverse charge basis, something that we don't normally see on financially settled derivative trades. And so VAT invoices are supplied on our trades, whenever an allowance is purchased. So then the buyer then is required to self-account for this, and obviously can claim any applicable rebate. So in addition to this, there are regulatory policy decisions that are mandated, that we see having a direct impact on supply and demand, and then therefore price. This is a bit of a moving target. The EU and the UK both continue to refine the scheme to help their respective zones to exceed their net zero commitments. So when we think about kind of regulations that we've seen recently, one of the main ones on the EU side was the Fit for 55 regulation. So that recently mandated the EU to reduce emissions by 55% in 2030 compared to the 1990 baseline. And that brought in new sectors such as maritime from 24 and transport from 26, which will have an impact on supply and demand moving forward. And even yesterday, the EU Commission announced their interim 2040 target. So this is something that, when you think about buying and selling or trading these, we do see these. Apologies for that. I think this happened last time, actually. Just bear with me 1 second.
Always technical glitches, eh?
There we go. Reducing our emissions, keeping the lights on. Yes, even yesterday, the EU Commission announced their interim 2040 target to reduce emissions by 90% by that 2040 date. And they also said for the very first time, really made it really clear that they expect voluntary offsets, so removal credits, to be absolutely necessary in meeting their net zero targets. And so this has caused the market to speculate that perhaps voluntary removal certificates from European-based projects could be admissible under the EU ETS in the future, but we're still looking at how this could potentially impact the market moving forward. When we think more on the UK side, again, lots of regulations since the UK scheme was brought out of the EU scheme in 21. Last year we saw the ETS reform response published. This confirmed a tightening of auction supply starting this year, but it actually watered down versus what was previously expected. So the market cap for the next 6 years is reduced from around 1.4 million allowances to 936 million allowances, but that was at the top of the proposed range of about 880 to 936. And so actually the market initially spiked, but then we did see that price collapse really into the summer. As we come into a global election year, now the market's waiting to see what environmental policies will look like, given the potential for changes in government. So would the market anticipate potential tightening if Labour are successful in the general election, and will there be more of a BAU approach if the Conservatives are successful? So obviously that can go either way, but these are some of the kind of regulatory things that people certainly are thinking about at the moment.
Okay, great. That's really useful to know. And you alluded to it a few times actually in your last answer, but that all important piece around price. So how have prices in the market been looking in the last year or so? And what are the price drivers? I mean, you've mentioned a few of them already, but what are the other price drivers that we should look out for?
Yes, absolutely. I mean, it has been a bit of a bloodbath really over the last year. Prices, when we look at the December 24 EUA UKA futures contract, that declined by 15% and 37% respectively over the course of last year. Spot prices have been even harder hit. And some of the reasons for that, hampered by weak industrial demand. And then we've seen ample LNG supply, strong renewable energy generation, and mild weather. And so, those have impacted, nat gas supplies, allowing EU stockpiles to refill at record rates, providing a bit of a protective buffer to the winter heating season, which did fail to deliver strong inventory withdrawals. And we do obviously see, because gas is such a key input into power generation, we do see, carbon prices, following, the trend that we see in gas prices, as you would imagine. So yeah, on the UK side, prices started last year at a premium to EU prices, due in part to the lower liquidity and the kind of idiosyncrasies of the energy supply mix into the UK. But then, thanks to that demand destruction and the changes, in that ETS reform response that I mentioned earlier, prices now are at a significant discount. So what are the things that we look for? So liquidity is a key concern, for our clients. Where is the liquidity, and how do they find that liquidity in the market? So the EU's got daily spot auctions administered by ICE, and the UK has weekly auctions. But there are times during the year, such as summer or the Christmas period, where these auctions don't take place and liquidity is impacted. At the moment, we see liquidity around 10 times higher on the EU ETS compared to the UK. And that is reflected on the types of trades that our clients look to do. Other things that we'll think about are kind of non-commercial positioning. The market can certainly be influenced by how long or short the non-commercial players are, and these positions can quickly exacerbate price moves both to the upside and the downside as positions are unwound or stopped out. So when we do see these sort of jumps in forward prices, it could be that that's what's happening. Think about spark and dark spreads. So this is the prices of the input of, say, coal or nat gas compared to the price of electricity. These give an idea to the coal to gas switching levels, which especially in Europe will determine how many additional emission allowances are required for the more dirtier power production installations. And again, that will feed into demand, which will then feed into price. And then finally, thinking about credit requirements obviously when people are trading these forward on a physical basis, there is the potential to separate delivery from payment by 2 days, 5 days, similar to kind of the settlement that we see on financial derivatives. But the difference here is that this does impact the hard credit requirements, which can be up to the full notional of the trade. So then credit restrictions in terms of who you're able to trade with does come into play. Many brokers only offer spot prices, for example. So that does bring the banks and their credit lines into play here. And so how some clients look to overcome this is by taking same-day delivery and payment to minimize these credit spikes, if they do have the kind of operational capability to do this.
Okay, great. So lots of factors to consider in terms of where we have seen price activity and where the market has been over the last year. But I mean, looking forward, where are we expecting these prices to go in the future? Do we have a view at Lloyds on the market over the next year or so?
I mean, we don't have a house view as such, but if anyone wants to kind of, give me a call or Jack, Peggy, Erin on the sales desk, we produce kind of a weekly update, which does look at, gas, power, emissions, and what's going on in the market. And we're more than happy to give our personal views and kind of what we're seeing happen. I mean, the 2024 outlook on carbon is, especially in the near term, is a continuation of the bearish factors that did see prices drive sharply lower at the second half of last year. So prices will probably continue to struggle to move out of trading in the current ranges that we're seeing at the moment. The market has entered a state where commercial and compliance activity, is a bit inconsistent, and there's no strong evidence of, opportunistic buying really. So at the moment, it is a bit of a wait and see, but clearly, at these prices, we are seeing lots of, consumer interest for sure. Looking a bit more kind of longer term, probably going to expect there to be more increased support from 2026, after the introduction of the CBAM, which is the Carbon Border Adjustment Mechanism. This will effectively kind of levy carbon intensive goods coming into the EU, and so will be phased in and will possibly see increased demand over time. New sectors being included into the scheme, such as maritime from this year. And so we're thinking that 60 euros is probably going to act as a soft support for prices. I think Germany considered that to be a good level earlier this year. Obviously the UK has an auction reserve price of £22, and we've been fairly close to these floor levels. So I think moving forward, if we think of £22 and potentially 60 euros as a floor, then potentially there is a lot more kind of upside moving forward longer term. And so clients, yes, considering this quite a good entry point here. And then, I mentioned we don't produce a house view as such, but there are research providers out there. So, One Energy Aspects, does have fair value forecast for 24. They're looking at €73.39 per metric ton. But then when we do consider, the impact of, short positions weighing on prices at the moment, if we do see a breakout of the current ranges and some of that starts to be unwound, then we could see prices, move higher at pace. So those are kind of the things that we're looking at and expecting to impact prices in the future.
Okay, great. And I guess you've touched on this as well over the last 20 minutes at various points, but in terms of client activity, what have we seen and what are we seeing? What are we expecting to see at Lloyds in terms of client activity? And I mean, I guess carbon trading for a lot of our clients can be quite a niche topic, but how many clients are we seeing that are interested in trading this? I'm just going to switch the lights off in my room as well.
So we started trading around a year ago, and I think it's fair to say that we've gone from kind of 0 to 100 in a short space of time. We've got multiple clients set up to trade across, airline, manufacturing and industrial, energy production, utility sectors. As I said, historically, brokers or advisors have played a large part in this market, but generally only offer spot trades and don't really allow any kind of form of risk management. Whereas we can trade, several million allowances up to 5-year forward, at a time, with minimal, slippage on price there. Really, we're talking, 10 to 20 cents for a couple of million allowances out 5 years, which, is it's just a game changer really in terms of being able to risk manage, some of this volatility. Obviously as well, when we think about brokers, there's the additional counterparty credit risk there compared to, a well-rated international bank. So what are we seeing on the UK side? Clearly where there is less liquidity, we are seeing more spot purchases. Liquidity is lower, forward spreads have been, much wider, so that's been prohibitively expensive. But as the prices collapsed and spreads have come in, that is starting to change now. And so even on the UK side, we're seeing interest, out 4 to 5 years, given where prices are, at these historic lows that we're seeing. On the EU side, liquidity is much better. The majority of clients are forward hedging to the nearest, certainly 1, maybe 2, December contracts. And again, there we've got firm interest out to December 28, with clients able to trade around, buy at 70 euros for 28, which only a year ago was trading around 130, 140 euros. So you can see, the impact to trade further out, just gives clients that optionality, and the ability to beat budget if budgets were set last year when prices were much higher.
Great. And again, you've gone through in your answer some of the tenors that we're kind of seeing. But what about things like what products are we able to trade? What's the furthest tenor we can go out to, and what is our offering from the desk? And I guess on the back of that as well, what do clients actually need to have in place in order to trade? Is it as simple as just an updated ISDA or credit, or what is it? If you could just go into some of the details around that.
Yeah, so we can offer, spot trades and then both physical and financially settled forwards out to 5 years on both UKAs and EUAs. We can also do, financing or yield enhancing trades where clients can trade a spread. They can sell spot buy forward or buy spot sell forward. If they wish to finance against, inventory they've got, on balance sheet but don't need to surrender quite yet. They can look to raise, working capital against that. And then also similarly, if they want to buy spot and sell forward, they can look at a yield enhancement trade if the emissions curve is pricing above the vanilla deposit for a similar tenor, and we're able to quote those as and when required. And then the docs, fairly easy. If you've got an ISDA in place, then it's an emissions annex is required. We just use a standard ISDA template, so not much changing there. We just need to make sure that we've got everyone's physical emission account details. We exchange VAT details and SSIs, but it's a fairly painful process. And obviously for spot trades, we don't even need an ISDA. So lots of opportunities and not too much pain on the doc side, which is not very often that we say that at a bank. So that's helped lots of clients to get set up pretty quickly and then start trading.
I think even Luke, you're surprised at how pain-free it is, because you actually just said painful process. So
okay.
Yeah, it is relatively pain-free on our side. So okay. So we can see why we've had an uptick in numbers in terms of the number of clients that have actually kind of been onboarded over the last year or so to trade carbon. So it's all kind of positive at our end. So great. I think we've crammed in as much as we can on the basics of carbon trading there. So hopefully that's given everyone a pretty good overview. I think we've got one question that's come in from Simran. So how could the new EU ETS2 market impact the current EU ETS scheme and the current price?
Yeah, no, it's a great question, and that's kind of what we're keeping an eye on at the moment. So at the minute, the ETS2 scheme is set up for the transport sector, and as far as I'm aware, at the moment, the plan is to keep them fairly separate, so non-fungible, and that the kind of new sectors as they get brought in will trade the ETS2, and the ETS, the original ETS, will continue on. So that's kind of my take on it at the moment. I think in the short term, probably not so much of an impact. But again, moving forward, these things are all in flux. So, if we do get to a point where, CORSIA eligible offsets are included in the EU ETS, or the kind of removal offsets, as I mentioned earlier, are able to be brought in, will we see a point where, ETS2 credits are brought in and we have one ETS? These are all very live questions. But I think, in terms of kind of the direction that the EU is going in, obviously, we've got very strict targets for kind of, 2050 net zero, 90% by 2040. So, free emissions, going out of the window, in the next year or two. So yeah, so the drive really is to, to reduce emissions, and, prices will have to be high or potentially driving higher, in order to, to have that, desired effect. So in terms of pricing, when we look at the forward curve, that's where the market is currently pricing, the future. And so I do think that, yeah, as I mentioned, looking to the, have to be looking to the upside, on where the risk is, moving from current levels. But as we do get, more information on, all of these different nuances, then, we want to be at the front. We want to be in people's inboxes with updates, and on the phone as well. So, yeah, more than happy to expand on that as and when this new info becomes available.
Great. Okay. So I don't think we have any other questions, but if anyone does have anything or has any afterthoughts, Luke and I are always kind of available. Please do get in touch. We also welcome any feedbacks, any thoughts or suggestions you might have for other topics which might be relevant. Please do let us know. And you can also sign up to the mailing list on our website to receive these monthly invitations straight into your inbox. So hopefully making things easier, and obviously being at the forefront of your minds. But other than that, until next time, thanks everyone.
Thank you. See you soon.